Hello traders, welcome to the first module of the Advanced Technical Analysis course where you will learn all the basics on technical analysis. On this lesson, you will learn the importance of historic support and resistance levels. Well, first of all, let's define what support and resistance is. Support and resistance are levels that have been tested at least twice. The more times the level has been tested and rejected, the stronger the level is. Immediate support and resistance are levels that have been created in the short term. Let me explain you what this means. The immediate support and resistance levels are the levels that you can see on the 50-minute chart, for example. Let's say that you are day trading the Euro-US dollar, and then you have a level where price came down and tested it once and twice. That is an immediate support and resistance. And the immediate support and resistance are strong on a day-to-day basis, maybe on a weekly basis if price is not moving a lot. But historic support and resistance are points of inflection in the market. Now this is where all the difference comes into play. Immediate support and resistance are levels that can or cannot be broken easily, and historic support and resistance are points where price already tested, or levels that price already tested countless times in the past. These levels are found on the 4-hour, daily, and weekly chart. And why is it that the historic support and resistance are drawn on the higher time frames? Well, that's easy, because on the higher time frames you get rid of all the market noise, and all you have is the pure market structure, and you will see the actual points of inflection, or the points where the market was rallying or was dipping harshly and turn around. These levels are very strong and must be utilized with attention when trading and analyzing the markets. And why are these levels strong? Because there's a lot of traders looking at these levels, so there will be a lot of sell or buy orders at these levels, and this means that price will react to these levels. Contrarily, the immediate support and resistance might work for a day trader, but the institutions are not looking at every support and resistance that is created on the 5-minute chart or on the 50-minute chart. Institutional traders only care about the overall market structure and the overall moves. So if you don't pay attention to these historic support and resistance levels, you might actually be in a good trade or in a profitable trade that instantly turns on you in the middle of nowhere, meaning that you hadn't drawn any support or resistance levels there, but the market just turned around without you even noticing. And this is what happens to beginner traders. They only use the immediate support and resistance levels, and they trade off of them. No. On this course, you will learn how to use not only these important points of inflection in the market and the immediate support and resistance levels, but you will learn how to use them in confluence with everything that you will learn here on this advanced course. And I think that the best thing that we can do here is go straight to the charts and try and look for some historic levels, and or maybe start with a 50-minute chart and draw immediate levels and see where the market actually turned without you noticing. Okay, here's my MT4 platform, and we have the major currency pairs on this profile. You can see that I haven't updated the futures contract on the crude oil, but it doesn't matter, because right now we are only going to look at the Forex market and maybe the S&P 500 and gold. So let's start with the Euro-US dollar, shall we? So this is the 50-minute chart on the Euro-US dollar, and what we're going to do here is we're going to draw horizontal lines on immediate support and resistance levels, okay? And we are going to draw Also horizontal lines on historic support and resistance levels, or what we like to call inflection points in the market. The difference is that we're going to use just black thin horizontal lines for the immediate levels, and we're going to use green and thick lines for the inflection points. So let's start. Now we clearly have here a let me just thin this up a little bit. Okay, clearly here we have an area of resistance that was tested, and it's being tested here again. Now the thing about this is that we also have an area of support right here. Remember that support and resistance levels, and this I think you already know, because this is not an advanced thing to know, but a beginner concept to grasp, is that support and resistance levels are not lines but levels. Okay, sometimes you might get spikes up or spikes down on the lines that you draw, but what you need to look for is true rejection. Like in this case, on the 50-minute chart, we went all the way back down to this swing low, but this candle closed outside. So some of you, or most of the beginner traders, would have taken a short position here without confirmation of an actual breakout. Okay, and then what happens? You have a blue candle that opens and closes above this swing low, which means that this is a fake out and you actually are in a losing trade. But we are not looking at this right now. We are looking at why it is important to look at higher time frames and look for inflection points in the market. Now let's assume that we are here, we are trading here, okay, and we see that price comes all the way down once, twice, three times. We have a little consolidation here, and then we move all the way up. Okay, and since this area of support is rejected, we decided to go long here, and our trade is going perfectly. Okay, and then what happens? We came all the way here, and boom, price reversed on us and moved all the way down to an immediate area of support, that is this one that has been tested once, twice, three times, and now four times. Okay, but why is it that that price moved sharply from this level to this level? Or why is it that price rejected the 3666 area once, twice, and three times? You can see it here by the wicks of the candles, and then an engulfing candle that signals a reversal where we did not have any support or resistance lines. What we need to do is we need to go to the 4-hour chart, and let's look at the 4-hour chart. Okay, shall we? Now the 4-hour chart gives us an area that might be of interest to us. It is this area right here, which we are going to color a green thick line, because this is a swing low in the market. And if we continue, you can see that it is in fact an area of support right here. And if we go again further back on the 4-hour chart, you can see that this area was held as support here too. On December 23rd, it was held as resistance during the second week of January, and at the end of January it held as resistance too. It was tested as resistance on February 10th, then as support on February 25th, and then right here it barely touched it before going all the way up. Of course, that we can also draw another area of support right here. You have one test, two tests, and you can see that this line of support in confluence with this line of resistance and support right here forms what we call the area of support that price has to test and reject for us to get long on the 4-hour chart. Okay, this trade would have yielded easily about 190 pips. Okay, now we have our historic areas of support and resistance. Now we're going to go back to the 50-minute chart, and just let me go back quickly. And here we are on the 50-minute chart. You can see, and you can clearly see that price went all the way up to this inflection point in the market, and of course it didn't touch it, because remember that support and resistance are areas, they're not lines, and orders might have been sell orders might have started at the 36.66.5 all the way up to the 36.73.5. So of course, if we don't have this inflection point or this historic line of now resistance but previously tested as support and of course as resistance too, we wouldn't know that we have to put our limits or take profit levels around it, and we missed on the trade, and of course we leave a lot of money on the table, and if we are not disciplined enough we can even lose money if we let the trade go all the way down here. So this is why historic levels of support and resistance are important, and the best thing you can do is actually go to your charts and go back on your charts and see which levels have been tested once, twice, 3 times, 4 times as support, then broken, then retested as resistance, and draw them. And then if you are analyzing price action on the 50-minute chart, you will see them because you will draw them in another color and a thicker with a thicker line. So this is actually what we wanted to teach you on this lesson, and stick with us because this is getting very interesting.